A government shutdown is no good for the U.S. economy, although it's not terribly detrimental at first. If it goes on for a longer period of time, we're told it's a real problem. How do you see it playing through in the markets?
Yeah, no, I mean, it's coming with a backdrop, of course, of rates going up and a lot of discussions about the overall very significant increase, in particular in long rates. But the short answer to your question, Matt, is that if this is temporary, and remember the average shutdown has lasted 8 days. It happened to be that the last one we had lasted 34 days. So you can spend some time thinking about, well, if this lasts 8 days, it may be more manageable. If it lasts 34 days, it may, of course, be more problematic. But the biggest issue, of course, as you, of course, also have talked a lot about, is that, well, if it has implications for us in markets, the number one implication really is on the data releases and what's going to happen to, most importantly, the employment report next Friday, what will happen to the CPI report. There's a lot of uncertain things, not only in terms of the macroeconomic impact, but also in terms of the darkness that might come if we don't get the data that we all look so much at when it comes out.
We saw the 10-year yield yesterday go to, briefly, I think it touched 468. Obviously, it's the highest level that we've seen since before the financial crisis. You put out a list of reasons for higher yields that I think got a lot of play, at least here on Bloomberg TV. The U.S. sovereign downgrade, Japan exiting yield curve control, Fed QT, fewer dollars for China to recycle, and a falling exports environment, the U.S. budget deficit, and the large stock of T-bills and Treasuries' intention to increase auction sizes. Do you add this to that list, or do people actually buy Treasuries, pushing the yields lower when they're worried about the U.S. government?
Well, that's a really good question because, I mean, we're sitting here literally the last trading day before that shutdown might arrive on Sunday. And the market reaction, I mean, just in the last few hours, it doesn't seem to be that there's too much worry about this having any negative impact on the economy. And if you also add the headline we just got from John Williams, where he basically said, which was quite different from what the FOMC was saying at the last meeting, he was basically saying at a speech in Long Island, well, maybe we are at the peak in rates. Remember, the Fed said at the last meeting, well, we will need another hike this year. So maybe even the Fed is beginning to signal that they are worrying about this spike that we're seeing in rates at the moment. So I completely agree with what you're saying, Matt. It is a bit unusual that maybe markets are just not paying too much attention because they think that this will soon be over. But as we know from the last shutdown, that this, if it lasts more than a month, it could certainly have a number of ripple effects. As usual, the most important ripple effect is that people, of course, will begin to hold back on consumption. A lot of functions will be shut down, not only on the data side, and that will ultimately begin to have negative consequences. Remember, I can't go for lunch twice when the economy reopens. So if I don't go for lunch because I'm a government worker for the next several weeks, then we will not get that GDP back on a number of different fronts. So the bottom line to your question is that there's still a lot of uncertainty, and it is a little bit worrying that rates are not moving lower on the back of all the things that you listed and all the things that are going on at the moment.
Torsten, let me just then, given all that, ask you about the inflation outlook from here. We ran some comments from Larry Fink earlier, who was painting this picture of a new inflationary environment that is a different one than maybe what we had anticipated. I had a conversation with longtime economist David Rosenberg this morning, who just does not buy into the idea that we are in a sticky inflation environment, that we're going to be in for a rude awakening as we head through next year. Can you give us your current assessment of how the fight against inflation is going, and whether or not that is something that we have to be giving more thought to at a time when we're trying to determine if rates are going to stay higher for longer?
Well, I think the data this morning that we got on PCE speaks for itself. It was 3.7 and 3.9 on headline and on core inflation. Remember, the Fed's target, as we know, is 2%. So you can quickly come to the conclusion 2 is not 3.7 or 3.9. We are still quite substantially above the Fed's 2% target. So that's why it makes sense for the Fed to communicate clearly that we are higher for longer. So therefore, in my view, I do think that the cost of capital are permanently higher. We are in a situation, not necessarily where inflation will be a problem for many, many years, but we are just showing that the last mile in terms of getting inflation all the way down to 2 is going to be very, very difficult. Remember, last summer, inflation peaked at 9.1, and today we're now at 3.5, 4. but getting all the way down to 2, which is the Fed's target and what they've been mandated to do by Congress, is going to require potentially rates to stay high for a very, very extensive period. And what the implication is for markets, of course, is that the Fed is clearly saying we need to slow this economy down. We're not quite seeing it yet. We need to make sure that we get inflation back to 2%. And that's why the downside risk to growth, the downside risk to non-farm payrolls continues to be fairly substantial over the next several months, simply because the Fed is telling us they are just not done. And therefore, the consequences are, as we're seeing, default rates for high yield will continue to go up. Delinquency rates on credit cards and auto loans will continue to go up. In other words, to summarize it all, interest rates are biting harder and harder and harder on consumers. They're biting harder and harder on corporates, and those are the consequences of exactly what the Fed would like to see. So we should expect to continue to see that over the coming months.
And briefly, Torsten, as we prepare for possibly just having a lingering and looming question around uncertainty in Washington with a shutdown, we continue to navigate the labor strife, and we see that with the auto workers strike as well. How closely are you watching these pay disputes play out, and how does that factor into your inflation expectations?
Oh, absolutely. No, everything you listed is very critical for thinking about markets. And if you also add rising oil prices and rising rates, as we just talked about, I do think that the list of worries and potentially this rise in rates and especially the speed with which rates have gone up is a bit of an ominous sign for not only the economy, but maybe even also for financial stability. It is totally, of course, everyone can conclude this. It does seem very unsustainable that rates are going up with this speed at the moment. So something has to give, something has to, I wouldn't say break, but something has to move now where rates have gone up so quickly. We know that this is having consequences for consumers. We know that this is having consequences from a market perspective for corporates. So therefore, for the inflation outlook, for a long time, the economy was quote unquote doing fine. But the question is, over the next several weeks, and the first stop is the non-farm payrolls on Friday, will the economy still do fine in an environment where rates have gone up so quickly to such a high level? Because the risks are, of course, that this will begin to slow things down and ultimately, therefore, to your question, also begin to have an impact on slowing inflation down.
Torsten, we don't have a lot of time here, but, you know, I've been following your work for many months, and the consumer is a concern, clearly, for you. What is the aha moment when we realize we're going to go over the cliff edge finally? Do we need negative payrolls? Do we need lower GDP revisions? Do we need, you know, something external from Asia, from China, or from Europe even? What do you think pushes us over?
Yeah, this is really important, a good way to end our discussion. So if I, on my Bloomberg screen, look at what does the consensus expect to non-farm payrolls next Friday, the answer is 170,000 jobs created in the month of September. That sounds okay, but remember when the Fed started hiking rates, we were creating 600,000 jobs. Then 12 months later, 400,000 jobs, and now 170,000 jobs. If you on your Bloomberg screen type ECFC go and ask the question, what is the consensus telling me job growth will be in the first quarter of next year, meaning January, February, and March? The answer is the consensus is telling you we'll be at 12,000 jobs created only every single month in January, February, and March. So the speed of the slowdown is here in the pipeline. So we as investors should be expecting that the Fed is stepping on the brakes. And as you show on the screen there, 170,000, yes, that's good for now. But what's most important is that the lagged effects on consumers and on corporates is expected, according to the consensus, and also in my view, to continue to slow growth and slow down employment. So therefore, the answer to your question, Matt, is that the most important data point to watch is that we know inflation is gradually coming lower, but we not only need a soft landing in inflation, we also need a soft landing in employment, and that's the question we'll find out next Friday, if we are also on the road to getting a soft landing in employment or not.
Right, if we get that BLS data, because, of course, with the government shutdown, those people are no longer paid.